Hello and a good afternoon to you all. We are so glad that you could join us in today's session on IFRS S1 and S2 refresher and scenario based exercises. This session has been designed to provide you with a focused overview of IFRS S1 and S2 disclosure standards, complemented by scenario based discussions designed to kind of strengthen participants' understanding of how you can apply this sustainability and climate risk concepts in real life, world, and reporting contexts. My name is Amara RF07, and I work at Resources Future as a sustainability analyst. Here at Resources Future, um, we can say we're a climate policy and sustainability advisory company based in Pakistan, and we work at the intersection of carbon markets, ESG strategy, and climate finance. Our team supports industries, financial institutions, and governments in designing practical solutions for emission reductions, regulatory compliance, and market access. I would like to now hand it over to Roma, who is your speaker for today. Thank you.
Thank you, Amara. Good evening, everyone. I am the Sustainability Lead at Resources Future. Welcome to our interactive learning session on the IFRS S1 and S2 standards. First, we will refresh our understanding of the ISSB, and this will be then followed by a scenario drill, so an extensive scenario drill-based Q&As. So before we begin, a few important things to remember. This session will be recorded and the recording will be available on our YouTube channel. The channel link is mentioned in the chat box. Secondly, please feel free to use the chat box for any queries and questions, and we'll try to address them at the end of the session. And the scenario drills will be conducted on Mentimeter. The code will be shared with you later during the presentation. And lastly, our contact information is also provided in the chat box. So feel free to get in touch in case you have any queries. So let's begin. We talk about sustainability standards such as GRI or SASB or IFRS S1 and S2. But do we understand why is reporting sustainability information important and why standards are needed in the first place? So, sustainability reporting grew out of the environmentalism movements in the 1970s and 1990s when companies started voluntarily reporting their environmental impacts. Reporting and disclosing information about a company's sustainable performance and its impact on the environment, as well as the environment's impact on the company, are important to stakeholders for several reasons. So, stakeholders, including investors, lenders, and customers, use sustainability disclosures to assess a company's exposure to environmental, social, as well as governance risks. This helps them make better investment, purchasing, and partnership decisions. Secondly, clear sustainability reporting also builds credibility. It demonstrates that the company is managing its impacts responsibly, which strengthens stakeholder trust and also the company's reputation. Then, sustainability disclosures also lead to regulatory and market compliance. So, with the growing global and local ESG regulations, such as SECP's notification in Pakistan, or in EU, we have CSRD as well. So, these disclosures help companies meet compliance requirements and avoid penalties or exclusion from the global markets. Disclosures can also help companies access capital. Institutional investors and banks are increasingly integrating ESG criteria into their risk assessment and also capital allocation. So, I think someone is mentioning that there is an audio issue. Okay. We were talking about access to capital. So strong sustainability reporting can improve ESG ratings, and it can also lower the cost of capital for companies. And lastly, sustainability related disclosures can enhance company sustainability as well as financial performance. So, disclosures make it possible to benchmark progress on sustainability goals, identify performance gaps, and also drive internal improvements. And this in turn enhances both the financial and environmental outcomes over time. With the growing interest in reporting sustainability related information, sustainability standards were introduced. And the purpose was to streamline the reporting process so that the information which was disclosed is consistent and complete and also comparable. But currently, we have more than 80 sustainability disclosure frameworks and standards, which also results in confusion and challenges when reporting in different jurisdictions. In fact, the whole sustainability reporting landscape is being frequently referred to as the alphabet soup of standard setters and frameworks due to this vast number of standards that are present today. And for this reason, the IFRS Foundation took a step to standardize reporting by developing the S1 and S2 standards. And now we'll move on to the S1 and S2 standards. So the IFRS Foundation took this initiative to consolidate key standards in order to form a global baseline for sustainability disclosures. And these are designed to meet the information needs of investors, particularly. In 2024, the International Sustainability Standards Board, the ISSB, which is an independent body responsible for developing and updating the sustainability disclosures, launched two standards, and more are expected in the coming years, especially for biodiversity and water. So, if we look at this diagram, we see that the organizations or standards mentioned all contributed to the formation of S1 and S2. Most of these organizations focus on investor needs, except for GRI, which targets other stakeholders such as customers as well. The Climate Disclosure Standards Board, CDSB, Sustainability Accounting Standards Board, SASB, and Integrated Reporting Initiative, which are mentioned at the bottom of this diagram, they were all consolidated into the IFRS Foundation. The TCFD, Task Force on Climate Related Financial Disclosures, is also disbanded now, and the IFRS Foundation has built its standards on the architecture of TCFD. This means that information on governance, strategy, risk management, and metrics and targets is required by S1 and S2 as well. Then moving on to the transition plan task force, this offers guidance on the disclosures for transition plan, which is now taken over by the IFRS Foundation. Lastly, on the right hand side, we see the CDB and GRI, which have also been aligned to the ISSB standards. So the purpose of discussing this diagram is to show you the harmony between all of these standards and how the reporting landscape is being simplified through the introduction of the IFRS sustainability standards. Till now, the ISSB has developed two standards. These are S1 and S2. S1 presents the general requirements for disclosure of sustainability related financial information. It asks entities to disclose material information about its sustainability related risks and opportunities that is useful to primary users of general purpose financial reports in making decisions relating to providing resources to the entity. I understand that all of these terminologies might be overwhelming, but we will break them down in the next slide. As far as S2 is concerned, it is the climate related disclosure standard, and it asks entities to disclose material information about climate related risks and opportunities. S2 is to be used in conjunction with S1, and both standards provide guidance to entities on how to disclose and how to report information that is expected to affect a company's value. So we saw the definition of of S1 and S2 standards, and there were a lot of terminologies. Now we can break them down and understand them one by one. And the IFRS Sustainability Disclosure Standards asks for material information. So what is materiality or material information? The standard defines material information as information which, if omitted or misstated or obscured, could reasonably be expected to influence investor decision. This definition makes it clear that the disclosures focus on financial materiality. So, material topics would be sustainability related risks and opportunities that can impact a company's financial performance, and are of high importance to the investors, which are the key stakeholders in this case. This brings us to the intended users of the reports of S1 and S2. These primarily include investors, lenders, and creditors. And then lastly, these stakeholders will be seeking information useful for decision making, information that could be expected to impact the entity's cash flows, access to finance, cost of capital. This is the kind of information that the investors are looking for in the sustainability reports, which are aligned with S1 and S2. So now we will briefly see what are the core contents of S1. I mentioned previously that the standard builds on the TCFD architecture. So all the disclosures will be aligned to these four pillars. First, we have governance. Governance asks for disclosing the entity's board oversight of sustainability related risks and opportunities, as well as the management's role in managing those risks and opportunities. Investors would like to know whether an entity treats sustainability disclosures as business as usual or a separate exercise. Secondly, we have strategy. The objective of disclosing strategy is to disclose the material risks and opportunities that the company has identified and what could be the expected impacts and the company's capacity to deal with these risks and opportunities. Under risk management disclosures, the companies are asked to describe the process through which risks and opportunities are identified. So, for instance, the process of materiality assessment adopted, or if financial institutions have adopted ESRM manual, if we are talking about Pakistan, or complying with the state bank's regulations, and how those risks are managed and how these processes are integrated into the entity's overall risk management framework. So these are the disclosures required regarding risk management. And lastly, the standard talks about metrics and targets. So metrics and targets disclosure give information about the metrics a company uses to measure the risk, such as GHG emissions and opportunities and its performance against targets. Sorry, that are set by the company or are required to meet regulations. So we have seen S1. Now let's discuss S2. So the S2 standard is developed for disclosures of climate related or climate specific risks and opportunities. You may already be familiar with the two main categories of climate risks, that are physical and transition risks. Physical risks are driven by changes in the physical systems as a result of climate change, which could be acute or chronic. Acute risks are from sudden short term events such as extreme floods, The recent hailstorm in Islamabad, that was also an acute event. And chronic risks, on the other hand, are from long-term changes in climate patterns, such as sea level rise or a slow onset of drought. The second climate risk category is transition risks, which are driven by the transformation of the economy due to climate action. This could be due to policy interventions such as introduction of a carbon tax, or it could be technology risks or market risks such as shift in consumer preference for a certain product which might be more environment friendly. Additionally, S2 asks for disclosure of transition plans, if there are any, and climate resilience disclosures of the company's strategy or business model related to climate risks under different scenario. And lastly, it requires companies to disclose their scope 1, 2, and 3 emissions calculated using GAG protocol or other appropriate approach. Okay, so up till now, we have recapped the emergence and purpose of S1 and S2 standards by IFRS and the key requirements of S1 and S2. The standards have already been adopted in Pakistan. The SECP has mandated a phased approach for listed companies based on their revenue and size, as is shown here on this slide. Additionally, the SSCP's notification states that sustainability report should be located after the director's report in the annual report. The Scope 3 GHG emission disclosure is not required in the first year of reporting. And same goes for assurance, which is not required in the first year of reporting. And with this, we come to an end of the first half of the session, and we will now begin our Q&As. These are designed to get you thinking about various real-world cases to understand the application and scope of the standards. But before we begin, I will check if we have any questions in the chat box. And in the meanwhile, you may start joining the Mentimeter. The code is mentioned at the top of the slide. And till then, I'll check the chat box. Okay, apologies everyone. We have a bit of technical issue, so we'll have to change the window back and forth. But we can begin our sessions now. We have the first scenario drill, and it is about climate risks. So the scene that we have is that a global agribusiness company is based in Brazil. It grows, processes, and exports soy, corn, and other crops with operations spanning Latin America and export markets in Europe and Asia. The company operates large scale farms, irrigation systems, storage facilities, and a logistic network. You are part of the risk assessment team and are asked to classify the company's climate risks under physical and transition risks. So then start the Mentimeter. And we are already getting responses. Okay. So I think majority agrees that it's a physical risk, but there is some disagreement between acute versus chronic. All right. So the correct answer for this is physical, and under physical, it is an acute risk because wildfires are sudden events. It's not like that wildfires increase gradually over time, or the frequency might increase because of climate change, but it's a sudden event, so that's why it is physical chronic risk. Then moving on, another risk is salinization and groundwater depletion in key irrigated zones due to prolonged drought. All right, I think everyone is agreeing that it's physical chronic, and that's correct because drought is typically a low onset event, and you don't see the impacts of drought or water shortage very quickly or very immediately. The third risk is that the European importers of the company require verified deforestation free supply chains, or they'll impose bans. And you may also choose more than one answer here. So, overall consensus is that it's a transition risk, which is correct. There's a question in the chat. What are acute versus chronic risks? We discussed this previously. So, acute are climate risks that are sudden events and occur over a short duration of time, such as flash floods or hailstorms. And chronic events are slow events that take a longer and show changes in climate pattern. This would be sea level rise or droughts. Okay, so the correct answers are transition. It could be policy as well as market risk because the market is demanding a deforestation-free supply chain. There's a need in the market for this kind of product. And if this is not fulfilled, then there might be bans. So both the types of risks are correct. Next, we have investor pressure to set science-based emissions reduction targets and disclose scope 3 emissions. We have, I think, diverse answers for this one. Okay, so the correct answers are transition. And it is a market risk because there is a pressure from the investor side, but it could also be classified under reputation risk, because if the company does not fulfill this criteria, then their reputation might be harmed. And lastly, the last risk is costly upgrades to machinery needed to transition from diesel to electrified or low emission technology alternatives. This is correct. With the context we have, this is a technology risk for the company. So moving on, we have. So just have to change the slides. We have our next scenario drill, which is on value chain risks. You are advising a multinational textile manufacturer based in Bangladesh. The company sources raw cotton from water stressed regions in India and Pakistan. Activist groups have raised concerns about unsustainable water use across its supply chain, and the company's CFO asks that these risks aren't from our factories. So, do we need to disclose this under S1 reporting? So, what should the company do? I'll read the options as well. So first is they do not have to disclose the risk because it does not fall under the textile factory's operations. Second option is disclose only if there is a risk of reputational damage due to obscuring this information. Third option is yes, disclose and report the risk as IFRS S1 requires disclosure of sustainability related risks across the value chain. And last option is do not disclose because ISSB does not have a standard for water related disclosures. So everyone chose the right answer. S1 does require disclosures across the value chain. So the company will have to disclose this information. And for the same case, since ISSB does not have a specific standard for water currently, what should the company do? Should they consult the sources of guidance listed by ISSB or engage a consultancy to help them or copy their competitors' reporting? And feel free to choose more than one option. Okay, so majority agrees that the company can consult other sources. So yes, that's true. S1, S2 require entities to use SASP and other standards for guidance. And but the other two options are also true. So of course, this is something new. The standard is new, and you can always seek guidance and services from a consultancy. And the third option is also correct because the whole point of S1 and S2 is to present comparable information. So you can always look at your peers and other industries to assess what they have reported, how they have reported it, and then use those best practices. And this is an open ended question. So, for the same scenario, how would the disclosure, which was related to sourcing of cotton from regions that were affected by unsustainable water consumption, how would this information be useful for investors in decision making? So, this is just an open ended question to understand and know your thoughts. Okay, we have one answer. Investors prefer to invest in businesses that are more responsible. This will help them see that the textile business is responsible in its procurement. Yes. Investors will no longer think for long-term paybacks and will be focused on short-term paybacks. Okay. Investors may require the textile mills to source cotton through sustainable means. Correct. Okay. Okay, so overall, the conversation is going in the right direction. Investors are concerned with the company's financial value mostly, and sourcing cotton, which is the main raw material, from a place which might be susceptible to water shortage in the future because of the unsustainable use, can threaten the supply chain. And it will, of course, impact the business if it has to procure the cotton from somewhere else, might have to pay higher tariffs. So that's why this kind of information is very much useful for investors. Okay. So this is, I'll change my slide because this is scenario three. Okay, the scenario three is you're reviewing the draft sustainability disclosures of a mid-sized logistics company. The report omits reference to a carbon tax expected to increase operating costs by 4% next fiscal year. The sustainability lead argues that it's not mandatory yet, so they don't have to disclose this information because the carbon tax has not been implemented yet. So, what should the company do? Should they disclose this information in their report this year or wait for the next year? The options are they don't have to they don't have to disclose because the carbon tax has not yet been enacted. Second is yes, they have to disclose because S1 requires disclosure of sustainability related risks that could reasonably be expected to affect the entity's prospects. Option C is they don't have to disclose because the tax will not affect the current year's financials. And D is they have to disclose because omitting this information could mislead users and is potentially a material omission under S1. And then last option is no disclosures are required because it is only required when the law comes into effect. And we have quite diverse answers from the participants. So in this scenario, the correct answers will be B and D. The reason being disclosures are required even for anticipated effects. And in this case, they know that it will be enacted, the carbon tax, and they also know the quantitative figure for it. So 4%, they know the impact on their entity. So for that reason, whatever information they have at the point of reporting, the company should disclose it. We have another scenario. I'll change slides. So, a chemical company is developing a breakthrough low emissions industrial solvent. It's still in R&D phase, but early results suggest that it could open up new markets and cut scope 1 emissions by 30%. It's not yet patented, and management is worried about the competitive leakage. So their CSO says that let's leave this out of the S1 disclosures because it's a sustainability related opportunity, and disclosing it now would kill our commercial edge. So you're asked to advise them on this exemption if it is legitimate or not. So what should the company do? Can they omit this under their disclosures? And the options we have are yes, they can omit it if disclosing it would cause commercial harm and the opportunity is considered commercially sensitive. Option B is no, all sustainability related opportunities must be disclosed regardless of business sensitivity. Option C is yes, S1 allows exemption if the opportunity is not yet financially material. And option D is yes, they can omit it if because S1 provides an exemption for sustainability related opportunities that are commercially sensitive and not required by law. So majority has selected option D, which is correct. And in this case, option A is also correct because disclosing this information could also harm their competitive edge. They are correct. And S1 gives this relief for companies to not disclose such information. Option C is not correct because it states that the opportunity is not yet financially material. It might be material, but that's not the reason for omitting this disclosure at the stage that the company is at. So moving on to scenario drill 5, which is on transition reliefs. A publicly listed company in Pakistan will begin reporting under S1 and S2 after July 2025. The sustainability team is concerned that they don't yet have full data on scope 3 emissions and other sustainability risks. And they're also using ISO 14064 instead of GAG protocol for their disclosures. So can they still comply with S1 and report the information that they have at hand? The options are the company must delay reporting until it has full data coverage across all scopes. Option 3 is scope 3 disclosures are not mandatory in the first reporting year, allowing a phased approach. Option C is the company can use ISO 14064 based GHG disclosures in the first year. And option D is the company must immediately switch to using only GHG protocol or PCAP for emission measurements. And you can choose more than one option. So options B and C both are correct. The ISSB provides transition relief for the first year to companies. They can use approaches that are consistent with GAG protocol. And scope 3 emissions are not required by SECP as well. And there's also a transition relief from the ISSB on GHG emission disclosures. Okay, now we have our scenario drill 6, which is on TCFD alignment. A financial institution publishes annual climate disclosures based on the TCFD's four-pillar framework, which includes governance strategy, risk management, metrics, and targets. Their sustainability team asks, we are already using the TCFD framework. That means we are aligned with S1 and S2. So do they have to adopt S1, change their reporting style? So a mix of answers coming in. Option is A is no, while S1 and S2 build on TCFD, they require additional disclosures. B is yes, they are aligned with TCFD because the structure and disclosure topics are the same. And option C is no, IFRS S2 includes more detailed guidance on metrics, transition plans, and emission disclosures than that go beyond TCFD. And lastly, option D is yes, they're aligned with S1 because TCFD is the mandatory foundation for all S2 reporting. So full compliance is assumed. So if you're saying that they are aligned with S1 and S2, that means they don't need to report through S1 and S2 standards and they can continue reporting with TCFD. And you may choose more than one option for this question. So the majority is correct. Both A and C are correct options because TCFD does S1 and S2 do adopt TCFD structure and they're aligned with the structure. But they are different as well. We will see this in the next slide. So when you go through S2, you'll see that the standard uses different wording compared to TCFD, but essentially it captures the same information. The differences arise in the detail of information present. So, for instance, TCFD uh, does not give guidance on opportunity disclosures, whereas S2 specifically talks about climate related opportunities and sets a criteria for it. And other areas of differences or additional requirement by S2 include qualitative versus quantitative disclosure, which was not present in a TCFD. So S2 and S1, they set criteria for qualitative disclosures when they can be used rather than quantitative. So these are some of the key differences. And if you would like to know more about them, the document is present on IFRS sustainability website. It's a comparison between IFRS S2 with TCFD recommendations. So you can read more on it there. And then we have our last drill, which is about uncertainty of impacts. So you are advising a textile company that expects a carbon tax to be implemented in the coming year. They believe it may increase costs significantly, but there is uncertainty about the scope and, of course, the rate or the price of the tax. And the CF of the company thinks that they don't have a precise number yet. So, should they disclose this information or not? We have the following options. So, how should the firm report the anticipated impact of the carbon tax under S1 and S2? They don't need to disclose because the regulation is enacted until the regulation is enacted and quantified. S1 requires numerical disclosure regardless of uncertainty. The option C is if the financial effects are not separately identifiable or involve high uncertainty, qualitative disclosure is appropriate. Explain why quantitative data is not provided and disclose the expected areas of financial impact. So you may choose more than one option for this question as well. So majority has chosen option D, which is correct. Option C is also correct because in case quantitative information is not available or there is a high uncertainty, such as in this case where there is no information on the level of carbon tax, how much tax will be levied. In this case, qualitative disclosure can be made. But also, option A could also be correct because the tax has not been enacted yet. So there is a very high uncertainty that maybe it is not adopted in the next year or next 3 or 4 years. So it could be excluded as well from the disclosures. And with this, we come to an end of our drills. And from the last slide, we have a slide on qualitative and quantitative disclosures. So S1 states that a company can provide qualitative rather than quantitative information only in three cases. First, if the financial effects of the risk or opportunity are not separately identifiable. Second, if there is a high level of measurement uncertainty, like in our example. And third, for anticipated effects, quantitative information would not be commensurate with the company's skills, expertise, and resources. So, this is only true for anticipated effects. And with this, we conclude the session. I would like to take a minute and discuss Resources Future services. We provide extensive training and capacity building workshops focused on IFRS sustainability disclosure standards. And we have two options in-house as well as virtual workshops. We heavily focus on interactive sessions, and these include exercises, group activities, scenario drills, as we did today, and simulations as well. And they're suited for financial sustainability professionals and even board members. So we curate the content depending on the client's needs. We also conduct readiness assessments. So, if you would like to evaluate your company's performance or the readiness level for S1 and S2, identify the gaps and see which processes could be introduced to prepare for S1 and S2 reporting. Our company Resources Future could provide services there as well. And lastly, we also offer GHG emissions accounting. And we have our next webinar on ESRM readiness in 2025, which is a technical briefing for banks and DFIs. So stay tuned for that. It's going to happen in the next 2 weeks, and we'll keep you posted on our social media handles. Thank you everyone for your for joining today and for participating in the interactive session.